Yeah, we start today's market talk. This is for Women's Day yesterday. Warren Buffett invests like a girl, and why you should too. Because similar to a woman's approach to life, Mr. Buffett's approach to investing is studious, well informed, and patient. He is the opposite of overconfident male traders who tend to trade too often, take undue risks, think only short term, and follow the herd thinking of other investors. Now, the key question rest, nothing else is important, is which is troubling everybody is have the Indian markets bottomed out? Now, let's discuss that. Now, this week, heavens obliged the bulls. Dollar index fell below 105 level. Crude dipped to the lowest level since 2021. And Trump, after screaming that tariffs are here, compromised a little on them. And the Reserve Bank of India did all that it could to aid the liquidity measures in the current scenario. So what happened was China and Canada retaliated on tariffs, but then Trump announced some concessions for a month for them. EU leaders responded with higher spending on infrastructure and fiscal policy reforms, and German equity markets are already at all-time high. In addition, RBI implemented series of measures aimed at easing fiscal conditions and reviving economic momentum, starting with 25 basis point repo rate cut, open market operations, and long tenured dollar rupee buy sell swaps. But nothing much has changed fundamentally in the past 2 days for the market to make a pivot because none of the risks at global and local level have changed. Uncertainty is higher. Rupee remains vulnerable, FI's outflow and tariff uncertainty remains. Now the global tariff war is no longer a looming threat, but a reality. Countries targeted by Trump administration in trade wars are hitting back, whether it is China or perceived allies of US like Mexico, European Union, and Canada. Now, we have to keep a close eye on retail sentiment as the market navigates these uncertain waters. It's very critical because the thought process is the basis of all bottoms, etc., is that SIPs will continue, retail directly or indirectly will keep supporting the market and will keep buying whatever FIs are selling. Now, what has happened is DIs have absorbed much of FIs selling, but the cautious stance of retail investors could serve as a real litmus test for market stability. So better to remain cautious because the moment there is a fall in the retail SIPs or there is a dip there, this market will collapse because then it will be hurt both ways. Now, continued FI outflows and lingering uncertainty over global trade policies such as the ongoing tariff dispute might restrict any sustained upward movement, while growth triggers are missing and risk factors are looming. Over long term, trade war is detrimental to economic growth, while domestic urban demand and private and government capex is seeing a slowdown. A slowdown in exports due to tariffs will make matters worse. So if fundamentals deteriorate, so would the stock market returns. Now coming to technicals, I'll just highlight something very interesting here. If you have to watch the US bond yields. Now if you see here, the US bond yields were at around 3.6 in September, and then they started going, went up to 4.8. And this is the place from where the Indian markets also started correcting when the US bond yields started rising. Lower the yields in the US, higher is the spread with Indian yields. Means if our yields are at around 6.5 or so, and the US yields are at 3.6, the spread is 2.9. But if the US yield goes to 4.8 and our yields are at 6.5, the spread reduces to 1.7. So higher the spread, higher is the appeal of Indian assets for foreign investors. Now, since September, markets started expecting persistent inflation in the US in anticipation of inflationary business, trade, and immigration policies. So the yield started going up. US yield moved from 3.6 to 4.8 from September to February, heading to narrowing spread against Indian yields as Fed was expected to hold rates. So if the inflation goes up, Fed was not expected to cut rates or keep the rates at the existing level or maybe raise rates also. And US dollar also appreciated as a safe haven currency in face of uncertainty. This triggered FII's outflow and stock market correction. Matter was made worse by high valuations of Indian equities and hope of recovery in China. Now, tariffs are expected to cut US GDP and lead to inflation as US production capacity will not be able to make up the gap in imports for few years. Imports would continue at higher prices. So they will keep importing stuff at higher prices because of tariffs. And unemployment in the US is expected to pick up as stance on immigration and Dodge, etc., will push up cost of production, and producers will have to resort to cutting employee costs to protect margins. Now, in view of that, there was an expectation that US markets will get into a recession. So after reaching that 4.8 level, and based on certain economic data, the yield started correcting, and once they started pricing in more amount of rate cuts in the US. So what they are pricing in is roughly 75 basis point of rate cut in FY25 only. So now what has happened is in US also there is a threat that there is likely to be a recession. So the long-term treasury yields, that is 10-year yield, has fallen higher than the short-term yield, that is 2-year yield. And if the yield on 10-year goes below 2-year, then it is called inversion, and that is why the recession starts, or that is an immediate sign of a recession. The thought process is that Fed will be eventually forced to cut rates to support a slowing economy. That's why the yield has started coming down. Now, what has happened is last Friday or so, the yield had gone to 4.1. Now, on Friday, there was a Powell statement where he said the economy is okay and we will hold rates. So the yields have bounced back. But nothing much has changed much here. Now, coming to dollar index. So if you see here, dollar index also from September onwards was rising from around 100 level. It went to 110. And then it has started falling, and it fell the maximum around 3.4% in last week only. This is because the tariffs have got delayed. Because the money was moving into the US economy as a safe haven and moving into the Magnificent Seven technology stocks, etc., and the US bond yields. So now what they are seeing is if they are going to be under recession, etc., and the yields are going to come down, so money is moving out, so the dollar is also falling. In addition, the other currencies like yen, euro, etc., against which the dollar is pegged, are also rising because people are expecting higher inflation in those countries. So the USD INR, if you see here, was started again going up after the RBI's action. Corrected a bit because the dollar corrected, so it has come to around 87 level. Now, Brent crude, if you see here, has come down to 70 odd level, went below that also. So this has to be watched. So at least this part, because of higher supply from OPEC, etc., there is no expectation of higher prices for Brent from here. That is why stocks like ONGC, etc., were correcting, and OMCs and those who were users of crude are doing well. Now gold, it had gone up and it's correcting. So now we'll have to watch this, but now it is below this trend line. So we'll have to see where it goes. So that's what I said, around 27.50 levels to dollars to an ounce, I would be interested in buying gold. Now copper, something very interesting has happened. It was dipping. Last week there was a rally. It went up 3.63%. Recent rally is driven by risk of tariffs on US, which the US is likely to impose. So the people have imported a lot of copper prior to the tariffs. and it is not because of supply demand dynamics. This rally may unwind if tariffs are not imposed. So there were a lot of volumes, etc. Now, if you see here, Bitcoin also corrected because of higher volatility and risk of trade. So it had gone down to below 80,000 rupees and has bounced back from there. So we'll have to see this. Now, US indices posted weekly losses of 3% due to tariffs uncertainties and mixed economic data, which has spoiled the sentiment. All gains sparked by election victory of Trump have been given up. So if you see here, November was the victory, and then he took over in January. So all gains have been taken care of, and now it has come down to that rising trend line level, and then from there it has bounced up. But it is below the 20 EMA, so Nasdaq corrected. Similarly with Dow Jones, it has also come below the 20 EMA and has now taken support at that rising lower trend line. We'll have to see where it goes. Now, January trade had huge spike in the US in imports ahead of tariff implementation, resulting in record trade deficit. Now, Friday's non-farm payroll report showed job growth is less than expected as federal employment took a hit because of various issues, uncertainty, dodge, etc. There was some respite, as I mentioned on Friday, as Fed Chair Jerome Powell gave a reassuring speech on US economy, but markets are pricing 70 to 75 basis point rate cut in 2025. That's why the US yields are coming down. So in the normal circumstances, if the US yields and dollar index is coming down, our market should do well. Fundamentally, we should do well. Right now, the sentiment is down, etc. But other emerging markets, etc., will start doing well. Now, India VIX, if you see here, it is not moving much despite all this bearishness. It is at 13 level also. So the volatility is not high. Now coming to Nifty, Nifty took support at the 100 EMA at around 22,000. It went below that. But if you see here, it is making that classic Elliott wave pattern A, B, C, D, E. So this has to be watched here. What it has come to is this level, because this 22,000 odd level was a level at which it has taken support for a long time. So this will not go that easily, but nobody can be sure about anything. So if you see on the daily chart, this is the pattern. So it has dipped and now it is at 20 EMA. So that is that level of 22,700. So if it goes above 20 EMA, there should be some strength here. And then the next line of resistance should be along this declining trend line. But it has to break this and make a, how do you see the trend has changed? If it starts making a higher high and higher low. To make a higher high, it has to go above this 23,800 level, 23,750 or 23,800 level. And to make a higher low, if it goes up and then comes down, it should be higher than this 22,000 level. So that shows the trend has changed. Otherwise, this is just a relief rally, because in March beginning of this month, it was oversold, as I had mentioned last week also. So it is just, or it could be just a relief rally. So we'll have to watch this till the time it is below 200 EMA. It remains weak. Now on the hourly chart, so if you see, there were two gaps here earlier. So this week it made a low and then started rising. So the first gap has been covered. Now this is a second gap and this level of 22,800 where it had consolidated for a very long time, and a lot of people thought that this is the bottom, but then it broke it. So this has to be watched. The good part is on the hourly chart, it is at higher than 20 EMA, so which is positive, but it had become slightly overbought and then it corrected and now it is consolidating, etc. So we've had, if you see here, we've had 3 positive sessions of making higher highs since 5th March. So it's a minor swing. I'll show you sectors, but metals, public sector enterprises, energy, small caps were the best performing because they had fallen the maximum. Whole thing could be a mixture of short covering, long creation, fresh buying in several popular stocks, etc. This rally has repaired the sentiment and portfolios, but sectors like IT, finance, banks finished in green marginally only, which have higher weightage. So 22,800, as I brought out, will be an important resistance zone. So Nifty has to clear that. This level has to be cleared. As Nifty has spent several days churning at these levels, sentiment can repair quickly if we get a strong move, but seems impossible seeing the daily flow of news. There are a lot of news which are floating around tariffs and trade talk with US, etc. So as long as 22,000 is not lost decisively, here the 22,000 where we have taken support is not lost decisively, correction is mostly done. In Nifty, small cap, mid caps can keep falling. So right now there are two arguments. First is sell the rally. It is clashing with buy the dip argument. So we'll have to see. You have to do whatever you are comfortable doing. It is, but it is better to be in certain cash because things are still uncertain. Now coming to Nifty Bank, last week it made a kind of a doji. Now it is again slightly above that, but it broke that 48,000 level. It went below that and bounced back. On the daily chart, it is it again recovered, but it has not fallen that much. So that 48,000 has remained a decent support, and it rose for 3 days and then dipped. But that 20 EMA remains a critical level to take out for this also. So I think Nifty and Bank Nifty should take out the 20 EMA simultaneously. Now the problem here remains HDFC Bank. It is stuck at that 200 EMA. So right now it is moving between 20 EMA and 200 EMA. So we'll have to watch this level. So if this breaks on a bad day, then it will take the market down. The last week, the leader was Reliance. It was oversold. It got oversold when it went to 1160, and then it has bounced from there. And now it is on this declining trend line. So if it breaks above this and goes past 1320, that should be positive because that is the 200 EMA. Otherwise, at every level, 1276 and 1320 or 1300 also, it should find resistance because last time also it went up to 1300 levels and came down from there. If you're stuck, use this opportunity to exit. This must be some fund buying or something like that. Nothing much has changed here. Now midcaps select, if you see I had given this level of 10,500 odd. So it's nearly went there and bounced up from there, but it has not moved much after that. So it is still stuck there. Resistance will be at these 11,800 odd levels. Similarly with small caps, it tested the lows of election day, went below that, then has bounced roughly 5% and all. This is basically oversold levels. So we'll have to see this, but if it can go up, that should be good for portfolios. But I'll cover this part in tax harvesting also. You must use these opportunities to get rid of all the small cap, mid caps or micro caps you're having. Coming to sectors, you see Nifty IT, it was down last week, so it hasn't moved much. Though it was oversold, but it is at generally the same level. So it is right now consolidating, but hasn't moved much from here. Similarly, Nifty Auto also was only up 0.24%. This is basically, again, it was oversold, but has not moved much, and it is below. All the moving averages are now coming below the 200 EMA. Similarly here, so if you see here, Nifty IT still only 20 EMA has come, rest has to still come down, so it can fall more. Auto has fallen tremendously and has come. So nothing much here in IT and auto. Now coming to pharma, pharma is also correcting. Now 20 EMA is below. It bounced a bit, but has not moved much. So we'll have to see this. FMCG is the weakest. If you see, all moving averages are below the 200 EMA. So it has bounced up a bit from here, 50,000 odd level, but this is again looking weak and constantly making lower highs and lower lows. The index which was doing well last week was metals. it has gone above the 200 EMA. So that is positive, and it has broken through. The reason is two reasons. Firstly, one, China has given decent GDP projection around 5%. So that is one. Second, the dollar has corrected. As DXY corrects, the metal prices go up. Third, Europe is also going to spend more, etc. So that is one more reason. And also, it could be also because the prices are moving up because of tariff threat, and also people are already taking deliveries before the tariffs are applied. Now I'll quickly cover uh, three stocks. First is Amber Enterprise. It's an integrated market leader in Indian room air conditioner RAC industry. The company has a presence across both the components and finished goods in HVAC industry, heating, ventilation, and air conditioning. RAC component portfolio includes heat exchanger, injection molded plastic components, motors, copper tubing, cross flow, and axial fans and sheet metal components. It has a 29% value market share in Indian RAC industry. The company also provides HVAC solutions for mobility applications. It supplies components for other appliances such as washing machines, refrigerators, and water purifiers. Basically, they are trying to now not be cyclical business where it is concentrated in only the 2 quarters of the year. It has ventured into PCB assembly and other electronic component manufacturing to reduce dependency on the RAC industry. It has set up a JV with Korea Circuits for manufacturing of HDI, flex, and semiconductors substrate PCBs, though its subsidiary Sidwal Refrigeration provides cooling solutions to railways, metro rail, and air-conditioned buses. Seeing their numbers, so I think this is achievable this year, doing around 9,800 odd crores. This I have checked. So they should do an EPS of around 80, 81 this year. Margins are improving as they are diversifying and doing backward integration. ROE, etc., is improving now. So next year they are expecting to do around 12,800 odd crore and 139 EPS. So at 130 to 140 EPS at 50 times, around 6,500 to 7,000 is a decent level for this stock, seeing the growth they are having. But if there is a problem with the growth or something else happens, then there is a problem. Now seeing their chart, so it had gone to around 8,000 plus levels, and then it has corrected. It took support at 200 DMA. So I think around 5,500, 600 should be a decent level to get the stock in case you get a dip here. It has risen from there, but it can always fall on a bad day. It has not fallen much. Rest of the stocks have fallen below the 200 EMA, etc., in a big way. So this has not really fallen, though it is expensive. So that's why I'm saying buy it on a bad day closer to the 200 EMA, where it has taken at least support 2 times, made a W, etc. So now it is going up. So you can look at this. Now coming to capital goods, what is happening is transformers, switchgears, CPCB4 generator sets, cables and wires, including extra high voltage cable market, HVDC, high voltage direct current technology, smart meters, etc., are showing fast-paced advancements and transformation. And strong government capex will be key supporting factors. So in my opinion, if you see the stocks like Larsen and Toubro, where they're expected to do around 140 odd EPS for FY26 and are at currently 2022 odd FY26 earnings, this is decent. Siemens, etc., they are expected to do strong growth. ROE, etc., is improving. So that is one. Then Cummins India, because of CPCB generators, etc. Again, they have become cheaper. They expected to do around 78, 80 odd rupee. So around 40 times 80 is 3,200, etc. So this is below that right now. Similarly, KC International, these stocks have become much cheaper. P's have come below 20, etc. Thermex, some like Hitachi Energy, etc., in my opinion, are still cheap. They can correct a bit, a long way, because In case these kind of doubling of profits or EPS doesn't come, then what happens? Thermex, etc. Again, good companies are becoming cheaper. So one can look at them around at these levels, 3,200, 3,300. Then Kalpataru projects, not power projects again. So if they do around 50 odd EPS in FY26, right now they are at around 16, 17 times. So FY26, so it's not very expensive. Now I'll cover about tax harvesting. It's very important. It is not a bad idea to review your investments and weed out the underperformance and rebalance your portfolio. Now, since you're getting an opportunity, if you have too much of small and mid cap exposure, I believe that you must reduce your small and mid cap exposure at this time, because the next set of rally for these stocks will come after another 2 3 years only now. Because government's capex, private capex, the consumption, etc., is not changing immediately. That V-shaped recovery is not happening, and these stocks will correct more. Now, the rule is capital losses booked in a year, short or long term, can be set off against capital gains made in 8 subsequent financial years. So, if you book your losses and restart again, you can set off those against capital gains made in 8 subsequent financial years. So, that is first, you should know the rule. Why I'm saying is because you have to restart. And now, what is happening is, what will happen is the leaders of the last bull market may not be the leaders of this bull market. So something which has worked earlier may not work now. We'll have to look for new themes. Now, short-term losses can be used against both short and long-term gains, while long-term losses can only be used against long-term gains. So in case you want to do offsetting of your gains against losses, 1.25 lakh is now tax-free. So setting off will occur on gains made beyond 1.25 lakh, as first 1.25 lakh is tax free. So I have finished. We'll take questions now.